Let me ask you something honestly. Have you ever opened a chart, saw RSI at 70, clicked sell with confidence, only to watch the market keep going higher without you? Or worse, you bought at RSI 30, expecting a bounce, but price kept falling like there was no support at all? If that sounds familiar, you're not alone. And more importantly, you're not stupid. You're just using RSI the way most people were taught to use it. The Relative Strength Index, or RSI, is one of the most popular indicators in trading. Almost every beginner learns it early. RSI above 70 means overbought. RSI below 30 means oversold. Simple, logical, and unfortunately, dangerous. Because markets don't move based on textbook rules. They move based on momentum, liquidity, and participation. And when a market is trending strongly, RSI can stay overbought or oversold far longer than most traders expect. This is where accounts slowly bleed. Not from one big loss, but from repeated counter-trend decisions. Here's the key mindset shift you need to understand: RSI is not a reversal timer. RSI is a momentum gauge. If you treat RSI as a tool to catch tops and bottoms, you will constantly fight the trend. Professional traders don't ask, is RSI overbought? They ask, is momentum weakening, or is it still strong? So if RSI is not meant to predict reversal, how do professionals actually use it? They focus on two advanced signals that align RSI with price behavior, not against it. These signals are failure swing and hidden divergence. Let's break them down carefully. The failure swing is one of the most powerful RSI patterns, yet most traders have never heard of it. Why? Because it doesn't look flashy, and it requires patience. A bullish failure swing starts when RSI drops below 30. Then it rebounds. Then it pulls back again, but this time, it fails to reach 30. That failure is important. It tells us that selling pressure is weakening. When RSI then breaks above its previous swing high, momentum has shifted. Notice something important here. The signal comes from RSI behavior, not from guessing where price should reverse. That's why this pattern works. The bearish version works the same way, just inverted. RSI moves above 70. It pulls back. Then it rises again, but fails to reach 70. That failure shows exhaustion. And when RSI breaks below the prior swing low, momentum turns bearish. Again, no guessing. No prediction. Just confirmation. Now let's talk about hidden divergence. This is not a reversal signal. This is a continuation signal. And this is where many traders get confused. In a strong uptrend, price might make a higher low, while RSI makes a lower low. To inexperienced traders, this looks bearish. But in reality, it shows that momentum is resetting, not reversal. This is why hidden divergence works best during pullbacks, not at random points in the chart. RSI should never be used alone. Always combine it with market structure, pullbacks, and dynamic support like moving averages. Indicators don't create signals. Context does. Before you take any RSI-based trade, run through this checklist. First, identify the trend direction. Second, look for hidden divergence. Third, wait for a completed failure swing. And finally, align everything with structure. If even one element is missing, you wait. That patience alone will save more accounts than any indicator ever will. RSI is not broken. Most traders just use it the wrong way. When you stop trying to predict reversals and start reading momentum, RSI becomes a powerful ally. Trade with the trend. Read momentum. And let the market confirm, not your emotions. That's how professionals use RSI.